Welcome to our series on investment analysis. Today, we're exploring one of the most important documents in the investment world, the prospectus. A prospectus is a formal legal document that companies must provide to potential investors before they can purchase securities. Understanding how to read and interpret a prospectus is a critical skill for making informed investment decisions. Throughout this video, you'll learn what a prospectus contains, why it matters, and how to extract the most valuable information from these detailed documents. A prospectus is a legal document that provides detailed information about an investment offering. Think of it as a comprehensive disclosure statement that companies are required by law to provide to potential investors. It contains everything you need to know about the investment, including financial data, risks, management structure, and the specific terms of the securities being offered. The purpose of a prospectus is to ensure transparency and help investors make educated decisions. By law, companies cannot sell securities to the public without first providing this document. There are four main types of prospectuses you'll encounter. First, the preliminary prospectus, often called a red herring, is the initial document filed with regulators before final approval. Second, the final prospectus is the complete document that includes final pricing and offering terms after regulatory approval. Third, the summary prospectus is a condensed version used primarily for mutual funds, highlighting key information in an easier-to-digest format. Finally, the shelf prospectus allows companies to register multiple securities offerings over time under a single filing, making it more efficient for frequent issuers. Each type serves a specific purpose in the investment process. Every prospectus is organized into key sections that provide essential information. Section 1 covers investment objectives, explaining the goals and strategy of the investment. Section 2 details risk factors, outlining potential risks and uncertainties that could affect your investment. Section 3 presents financial information, including historical performance and comprehensive financial statements. Section 4 discusses management and fees, introducing the leadership team and breaking down the cost structure. Understanding these four core sections will help you navigate any prospectus efficiently and extract the most critical information for your investment decision. Risk factors are among the most important sections in any prospectus. They outline the potential challenges and uncertainties that could affect your investment. Market risk refers to price fluctuations due to overall market conditions, which can affect even fundamentally strong investments. Credit risk concerns the issuer's ability to meet their financial obligations and pay back investors. Liquidity risk describes the difficulty you might face when trying to sell your investment quickly without significantly affecting its price. Every investment carries risks, and the prospectus is required to disclose these honestly and comprehensively. Financial statements provide a window into the company's financial health. The balance sheet shows a snapshot of assets, liabilities, and shareholder equity, revealing the company's financial position at a specific point in time. The income statement tracks revenue, expenses, and net income over a period, showing whether the company is profitable. The cash flow statement details cash inflows and outflows from operations, indicating the company's liquidity and ability to generate cash. Finally, the auditor's report provides independent verification of financial accuracy, adding credibility to the numbers. Together, these statements give you a comprehensive view of the company's financial condition. Fees and expenses can significantly impact your investment returns over time. The management fee is an annual charge paid to fund managers for making investment decisions on your behalf. Sales load is a commission charged when you buy or sell fund shares, which can be either front-end or back-end. The expense ratio represents total annual operating costs as a percentage of assets under management, covering administrative and operational expenses. Transaction costs include brokerage fees and trading expenses that the fund incurs when buying or selling securities. Understanding these costs helps you compare different investment options and calculate your true net returns. Reading a prospectus can seem overwhelming, but following a systematic approach makes it manageable. Step 1. Start with the summary section to get an overview of key points and investment highlights without getting lost in details. Step 2. Review risk factors thoroughly to understand potential downsides and uncertainties before anything else. Step 3. Analyze financial data by examining historical performance and financial health to assess the company's track record. Step 4. Compare fee structures by evaluating total costs against similar investments to ensure you're getting good value. This methodical approach ensures you don't miss critical information while avoiding information overload. Certain warning signs in a prospectus should make you pause and reconsider. Excessive risk warnings that dominate the document suggest the investment may be highly speculative or dangerous. An unclear fee structure that's difficult to understand often hides high costs that will eat into your returns. Poor historical performance with no clear explanation indicates management issues or fundamental problems. Lack of transparency in disclosures or vague language suggests the company may be hiding something. A complex investment strategy that's hard to understand increases your risk of unexpected losses. Frequent management changes indicate instability and lack of consistent leadership. If you spot these red flags, proceed with extreme caution or consider alternative investments. Let's recap what we've learned about prospectuses. First, a prospectus is a legal requirement for public offerings, providing comprehensive investment details that protect investors through transparency. Second, always read risk factors and fee structures before investing, as these directly impact your potential returns and losses. Third, focus on financial statements and management track record to assess the company's health and leadership quality. Finally, use the prospectus as a tool for informed investment decisions rather than relying solely on marketing materials or sales pitches. Remember, taking time to read and understand a prospectus is not just good practice. It's essential for protecting your investment capital and making smart financial choices. Thank you for watching, and happy investing.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.